Q&A. Mark?
Thank you all very much. Great, thank you. It's nice to be here, and it's nice to see a full house here in August, which is unusual, particularly living in Washington, D.C., where there's very few people hanging around in August anywhere in the Washington environment. I wanted to talk to you today about what's happening in the venture capital industry, both from an industry perspective and then get a little bit talk about what's happening from a policy perspective as well. I get a lot of questions, can we get these slides? Absolutely, all four associations are certainly allowed to put these on their websites, and you can download them from the four groups that are represented today. So first, let's talk about what's happening from the fundraising perspective. Where does the industry stand in general? There's been a lot of talk over the years about the shrinkage of the venture capital industry, and this shows it pretty dramatically. We have seen the number of firms be cut basically in half from 2000 to 2012. What's important to note here, though, is that the capital under management has not declined that dramatically. So what you're seeing today are firms, those firms that are left standing, and those partners that are left standing in these firms basically have a lot more responsibility for a lot more dollars. And some of that may go to the point of more firms looking at later stage deals, which they can put more money in and therefore continue to keep their firm moving forward. The other important point to note is that while there are 522 firms, many of these firms have gotten smaller as well. The number of professionals in these firms has shrunk because you saw firms that may have raised $800 million 8 years ago. If they went out in the last couple of months or last year or going out soon, they're going to be looking at many of them at a $600 million fund, a $400 million fund. You're seeing a lot of VCs in these established firms leaving the industry as well. And what's different from the past in this respect is that you used to see many venture capitalists, if they were given, frankly, some walking papers, being able to go out and raise their own fund, raise a small $100 million fund or a $50 million fund. You're not seeing that today. We'll see a slide here that shows that first-time funds, it is very difficult for an individual to go out and raise a first-time fund. So from a long-term perspective, what's happening is that people who are leaving the venture capital firms are leaving the industry as a whole, which is an issue long-term for the industry. This slide talks about VC fundraising. And as you can see, over the last basically 5 years here, we've been raising between $15 and $20 billion. That's, many would say, particularly those venture capitalists who have been able to successfully raise, the haves, that this is a good number. Of course, the have-nots would like to see that number go up. But the haves would say that when you have about $15 to $20 billion raised a year, that's the ideal size because you don't have as many Me Too companies being funded. The 15 petstore.com companies don't get funded in this environment. The 18, and these are literally numbers, 18 teen jewelry.com stores online that were funded in the bubble don't get funded. So the haves think that this is actually a pretty good period to be in. Now, an important note here is that this does not include corporate venture groups. We have seen, while the industry itself has contracted substantially, as we saw on that first slide, we have seen a corresponding increase in corporate interest in the venture capital environment. And you're seeing a very large number of corporations going out and creating venture capital arms. Now, this has happened in the past, and some venture capitalists will say, you know, been there, done that, seen this, and the result is going to be bad, because it's been bad the last few times. I think actually this is a very different environment. I think corporations are in this for the long term. I think corporations understand that they need to be looking at these emerging growth companies at a much younger age than they have in the past. Corporations are not doing internal R&D anymore. The way they do their R&D is by buying venture-backed portfolio companies. And so what you're seeing are corporations, not just domiciled in the United States, but all around the world, opening up venture capital arms. And what they're doing is that they're not just investing, if you're Johnson & Johnson, which has had a venture arm for forever, they're not just investing in drug companies or in medical device companies. They're investing in IT, they're investing in clean tech, because anything that helps their bottom line at the end of the day, they're interested in seeing. I think that you're seeing a professionalization in the corporate venture arena, just like you have seen it in the angel community. You know, there are still venture capitalists out there who say, I'll never work with the angel community. You know, I got screwed by them once and I'm not going to go do it again. And there are angels who will say the same thing about the venture capital community. I would never give my company up to those vultures who are going to take it in a different direction. I think that what we've seen over the last couple of years is an agreement, a tacit agreement among angels and venture capitalists that we need to work together. And angels need to create deals in such a way that make them attractive to venture capitalists so that that company can get to the next level at the end of the day. And you're seeing that symbiotic relationship in a much stronger fashion today than you have seen in the past. And I think the same thing is going to happen with the corporate venture groups. Overall, I think it's been a tough venture environment for the last couple of years. I'm more optimistic today about the venture entrepreneurial ecosystem than I have been in a long time. This is, the angel community is one reason, the corporate venture group area is another reason why I'm interested, where I'm optimistic, and we'll touch on a few more as we go through these slides. This is the slide that I was noting about the real dearth of first-time funds. As you can see here, it is extraordinarily difficult, the yellow bar representing first-time funds as opposed to funds that have gone out for their second, third, or follow-on funds. And those few that are able to do it are really very seasoned, very, very seasoned venture capitalists who have a network of high net worth individuals, friends, family, and to a lesser extent, institutional limited partners. Now let's look now at the other side of the equation, what's happening on the investment side. As you can see here, this industry invested $105 billion in the bubble, the year 2000. We are now investing about $30 billion a year, give or take. Now, those of you who have been listening carefully will think, wait a minute. The last 5 years, he said that we've been raising about $20 billion, and we're investing about $30 billion. You know, the federal government can do this really well. They've shown it. We can't. There's going to come a time, and it's coming soon, when we're not going to be able to invest as much money as that we're bringing in from LPs. So we have been sitting on some money for a number of years. We're putting that money out, but that well is getting drier. And so we're going to have to be out there raising some serious dollars in the not too distant future if we want to continue to see this move forward. Now, that $105 billion, as I said, that's the PetStar.coms, that's the teen jewelry. I think it's important to note that the bubble is really an important element, and everyone looks at it as a negative. I think that a venture capital industry without bubbles is not a very good industry. Think of the impact that this bubble has had on the U.S. economy since 2000. Where would we have been without the rapid movement of the IT sector in that period? And, I think a lot of people, there were unquestionably mistakes made during that time. We are still licking our wounds from the bubble. But I also think it's very important to understand what an economic generator that bubble has been to the U.S. economy and to the world economy. And frankly, as we look around at emerging democracies around the world, what it's done to the world as a whole, what that bubble did, and kind of put it in perspective. Yes, money was wasted. Yes, some entrepreneurs got burned, some venture firms got burned, some investors got burned. But at the end of the day, there were some amazing things that have come out of that bubble. Do we want to necessarily go back there? No, but you might, we're going to see bubblets all the time. And like I said, that's not necessarily a horrible thing. Just a couple of trends that we noted as we were ending 2012. Virtually every state in the union got some type of venture capital. And when I talk about venture capital, I'm not talking about angel deals here. I'm not talking about private equity. These are strictly venture. However, we continue to see California getting stronger, not weaker, when it comes to the amount of venture dollars and the number of deals being done in the state. And you will hear governors and many other parts of the country talk about, why would you open up a business in California? The taxes and the commutes and the smog and the cost of living and the housing. People want to be in California. It's that simple. Other states have tried their darndest to move people out of the state of California, and it's successful to a very, very limited extent. We are in an environment right now, which goes counter to what most people would think, that venture capitalists are actually investing more locally than they are in far-flung areas. We had some interest for a while in investing overseas, China, India, investing in all across the country. What you're seeing today is kind of a back to the future. Venture capitalists being very proud of the fact that they're investing within their area code. And they'll talk about that, and they'll talk to their limited partners about that we only invest in this very narrow geographic region because we think that we can find all those deals there, and we're close to those deals, and we can jump on a problem when if and one comes up. And you're seeing that particularly in California. Having said that, I think that one thing that most economic development folks either discount or don't put enough heavy emphasis on, and it's something when I was back here a number of years ago, I spent a day with Governor Huntsman going through how you can generate venture dollars and entrepreneurial dollars here. And what we discussed was the importance of things like ski slopes. The idea that a venture capitalist may have a winter home in Alta is really important because that means he's flying in here or she's flying in here over the winter months, and when he or she is here, they might as well look at some deals. That type of social attribute that this state has compared to other states is very, very important. The idea that you also have a good airport, that you can get from that airport downtown or to major entrepreneurial areas in a very quick fashion, very important from a venture capital perspective. A lot of other regions of the country simply don't have that. Plus, when you look at the education, the educated workforce here, much higher than other parts of the country. Cost of living, all that stuff you know. But getting the venture capitalists here in the first place is key. And those ski slopes help a heck of a lot. So don't underestimate them. A couple of other things here. I talked about the corporate VCs. They're now engaged in about 15% of all venture deals. It's a growing issue. And this is also important. A lot of talk in the industry about, the venture capitalists have abandoned seed and early stage. And what you're actually seeing today is an increase in venture capitalists kind of going back to those deals. I think that what you're seeing here, as I said, a lot of partners have more money and they need to do those late stage deals. As you see the exit markets get better, you see some of these companies that they have been dealing with for years finally leave the nest. What they want to be doing is looking at those early stage deals. And I think that's why you're seeing these numbers go up now, is that the exit environment, which had been pretty moribund for a while, is in fact getting better, and we'll talk about that in a minute. So let's turn to what's happening in Utah specifically, and then we can talk a little bit about what's happening to some of your neighbors as well. In Utah, this is very different than most states when I look at it. Of course, you had the bubble like everybody else, and you had the drop-off like everyone else did. But then you've actually seen much better growth over the long term, over the short term, excuse me, than many other states. Particularly over the last 3 years here, you've seen some very good, strong growth in both the number of deals and the amount of money coming into the state. This is only the first half. Already you're seeing some good numbers racked up as well as deals. So, as I said, compared to many other states in the union, Utah is in a much better place. I know there's always rivalries between states, and so here I just wanted to basically compare Utah and Colorado. And as you can see here, in the past, it was basically 3-4 to 1, and the last couple of years it's been less than 2 to 1 here by far, and particularly the first half of this year, very close together between what the state of Utah and the state of Colorado is getting in terms of venture dollars. This is also interesting in that, unlike some of the other regions, you actually are having a pretty healthy first-time funds. As I said, it's very difficult in most regions of the country and nationally, but here there's actually been a healthy number of first-time funds being raised in the state. That's very good news from a long-term perspective for the state of Utah. Now, this is interesting, I find, when you compare the state of Utah against Arizona, Colorado, New Mexico, and Nevada. And this is over the past 6 quarters, as you can see. Extraordinarily high investment in the software category in the state of Utah. Much more diverse in these other states. This other is well, it's not clean tech because that's clean tech. Medical devices, healthcare services, financial services would be over here. What I thought was interesting here from a Utah perspective, very little in the life sciences arena, both medical devices and biotechnology, not even in a couple percentage points here. Media is very unusual for any state to have a high amount of media deals being done. I don't know if that was just 1 or 2 deals or if there is something specific about that, but that also caught my eye. IT services, also a strong area, and there are 2 ways of looking at this. One is, you've found an expertise and that is in this area, you know, stick with it. The other one is if this area starts to sink, you're in trouble. So there are you know, other states where you see a much more diverse venture market than you do here in the state. So let's take a look at what's happening at the exit market. Excuse me. This is the number of IPOs that we've had. What's interesting to note here is that the first half of this year, we had 29 venture-backed IPOs. As of today, we've had 41 venture-backed IPOs. This number, we grew at 12 in usually a very slow period, July and August. We've had 12 IPOs. And we have a very, very strong IPO pipeline right now. So I could see this number surpassing anything since 2007 this year. I mean, we're not going to hit 92, but I think we'll surpass 69 this year. What's interesting to note here is that these are very good companies that are going public right now. You're seeing companies that have gone public in the last year. The vast majority of them are trading above their opening level. You're seeing excitement actually in many of these companies. They're not just in one industry. They're in medical devices, biotechnology, they're in software, they're in the cloud. We have even a couple of clean tech companies, very good companies going public. What is interesting here too, everyone might look at this and say, what the heck happened here? That's Facebook. That's one company basically that made a huge amount of of those dollars. And it shows you the impact that a couple of companies have on the venture industry as a whole. And that very often it is a needle in a haystack kind of industry. That you're going to, when you hit one, it can have a profound impact on what's happening. Now, you know, a lot of talk about Twitter going public now. We'll see if that has as much of an impact that Facebook had on the industry. But I'm growing more optimistic about the the IPO market than I have been in quite a while. I did see a blip on my BlackBerry saying that NASDAQ had stopped trading for a technical glitch. I don't know if anyone else saw that, but I don't know what's going on there right now. This is an important slide. We talk about the interest of limited partners seeing a return at the end of the day. We had, in the year of the bubble, 2000, companies were going public in less than 4 years. And that was certainly way too early for many companies to go public. However, 7 years is way too long in the respect that, you know, our investors are not going to wait 10 years to see a return. And that's basically where we are today. We had started to see this number go down, but suddenly it started to tick up again. It's gone down again, excuse me, in the first half of 2013. We just don't have that here. But we're still around 7 years for a company to go public, and that's a difficult environment. Now let's look at the flip side, what's happening on the acquisition side. What we have seen over the last several years is about 450 acquisitions a year, pretty consistent. Now, you can have 450 acquisitions, and as you can see, some years are fire sales and some years are actually quality acquisitions. What we saw in 2012 were very, very good acquisitions for the first 3 quarters, and then the wheels fell off the bus in the last quarter. And we have seen, since that time, a very quiet acquisitions market. I think a lot of this has to do with Washington. You know, the last quarter we had of 2012, we had the elections, we had the entire budget crisis, we had corporations sitting on a lot of cash and they're still sitting on it, but buying the companies they had to buy, not buying the companies they wish to buy. And we're still in that environment. That is very disconcerting to the industry as a whole. I think that now that the IPO market is opening, you're going to see this market get better as well, with the caveat that come October, we're at another budget crisis. And depending on what Washington policymakers do or don't do, that could tremendously impact what happens with these acquisitions. As I say, corporations are going to buy the companies they have to buy, they feel they have to buy. But we want them out buying the companies that they want to buy or wish to buy. I just wanted to show this from a historical perspective. It used to be that this was an industry that a lot of our companies went public. And we're now an industry that basically is an acquisition business. We'd like to see this basically at a 70-30 split. 70% of our companies being acquired, 30% of our companies going public. We certainly aren't there yet. The reason the venture capital community sees it as important for companies to go public is that, first of all, the vast amount of jobs are created after our companies go public. Vast amount of jobs created at that point. We're seeing the number of potential acquirers dwindle each and every day. You look at the number of listings on NASDAQ, New York Stock Exchange, they continue to get smaller. As the number of potential acquirers gets smaller, it makes it harder for us to actually get good deals out of potential acquirers. And the idea that entrepreneurs want to go public is really important. I think that where we were until the Jobs Act was enacted was many entrepreneurs saying it's just not worth it. It's just not worth the effort of going public and staying public and having to deal with the lawyers and accountants all day instead of growing my workforce or growing my company. And so a lot of them were more than happy to get acquired. I think that's actually starting to change now. I think that with the help of the Jobs Act and the economy, I think you're seeing more entrepreneurs say, well, at least I'll take a look at going public. I might not do it at the end of the day, but at least I'll look at it. I think that's very important, changing the psyche of the entrepreneur so that just the prospect of going public once again becomes that gold ring or that brass ring that it used to be. Just a couple things before we go to public policy. We're seeing less money being raised by venture firms, but we're seeing some great entrepreneurial companies right now. I talk to venture capitalists all across the country. I think most of them would say this is, if not the best time, one of the best times to be out there searching for entrepreneurs. It's a very healthy environment right now. But we have, our exit markets continue to be questionable. And our LPs are demanding, our investors are demanding that our money be put out in an efficient manner. And what this talks about is, we're seeing a lot of our investors saying, I understand the IT sector. I understand that there can be exits in the IT sector. I understand that money can be made in the IT sector. I don't have that feeling with the clean tech sector. I don't have that feeling as much in the life science sector. And so, venture capitalists, if you want my money, pivot much more toward the IT sector than some of these other. And you're seeing some firms today, because the power has shifted from the venture capitalists to the investors' way getting play. So I think that the boomlet in clean tech is just that. I think you will see some successes there, unquestionably, but certainly there is a lot of blood on the floor in the clean tech arena right now. In the life science arena, I think you'll continue to see interest In medical devices, biotechnology is harder right now because it does take so long to get an exit, and an exit actually that means something, that's meaningful. So the industry is under change, but I think that, and you will see a continued interest in IT because that is our bedrock. But I do hope for the industry as a whole that we can spread our wings and be in some other sectors as well. You should, if you're looking for more information, some things, particularly as entrepreneurs, to look at are our model documents. They're on our website. This is the most downloaded portion of our website by far. And what these model documents are basically the starting out agreement between an entrepreneur and a venture capitalist so that everyone feels going in that we're on equal footing. Take a look at these. These are used all over the world today. We started this program about 10 years ago, and it has been phenomenally successful, I think, in bridging that trust factor between an entrepreneur and a venture capitalist. So go on and take a look at those. And certainly we have all sorts of other information on our website as well. So with that, I'm happy to open it up for any questions. I think, yeah, we have some good time here if anyone has some questions. Yes?
You talked about the distribution. So you talked a little bit about California and the strength of investment here. And I worked on this as part of my dissertation, looking at Salt Lake and New York City and the growth that these soul communities have, whereas Colorado, compared to Utah, you already explained that, but in terms of optimal policy. So we hear stories about startup communities. I tend to view it as decreasing the efficiency if you have many different points. And we see that in California. What is your opinion about optimal policy? What should happen to be able to create the best environment for growth?
I think that New York is a prime example. I think Mayor Bloomberg has done an incredible job in being able to highlight the importance of entrepreneurship in an area that most of people would have thought there's no way in heck you can create an entrepreneurial business in Queens or Brooklyn or Manhattan. Mayor Bloomberg had that vision, and he has the personality to say, I'm going to do this, and I don't care what anyone says about it. And that's what's really important. The other thing that Bloomberg did, he intentionally went out and made a major effort to get a major educational institution in the city. Had that fight between Cornell and Stanford, and that has played to, I think, been a very positive thing. And you're going to see, I think, very positive things come out of the new university that's set up on the island. So I think a personality is really important, and there aren't that many who can do that. And I don't know what's going to happen now that Bloomberg is going to leave as mayor. Hopefully the seeds have been sown and they're deep enough in the ground that things don't peter out. When I look at what a region needs, there's a reason why Silicon Valley is there, there's a reason why Boston is there, and it's because of their educational facilities. There's no question in my mind. You have MIT, you have Cambridge, you have Stanford, you have the UC system, and they have not only been able to produce folks who have an entrepreneurial bent, they have also been very aggressive in their tech transfer policies, and they're not giving up their secret sauce. There's all these groups, we're going to try to be like Stanford. But Stanford's not going to tell you what they've been doing, and MIT is not going to tell you. But there are ways, I think, of creating an entrepreneurial community if you have that educational base, and a lot of regions don't. The other really important thing that I think folks forget about is that the venture capitalists, we're followers, we're not leaders. We follow the entrepreneur. So you have to have the entrepreneurial base first. And to me, there aren't that many parts of the country where the population as a whole is entrepreneurial. I live in Washington, D.C., and people say, Washington, D.C. should be such a great area for venture because you have all these educational facilities, you have a high net worth individuals who are very educated and sophisticated, but you also have people who basically want to see a paycheck every 2 weeks. And there are a lot of government employees. The idea of getting stock options or working for a month with with nothing coming in the door is not an easy thing for a Washington, D.C. resident to understand. California is very different in that regard. I also think that you look at some other regions of the country and you see basically immigrants, by their very nature, are entrepreneurial. They left a known country, a known language, and have said, the heck with that, I am going to gamble it all, and I'm going to go into a country with a different language, a different set of morals, all sorts of things, and I'm going to do it. They're entrepreneurial to start with. And so I think that areas that have that a high entrepreneurial, a high immigrant population are actually, at the end of the day, areas that are going to be much more amenable over the long term to entrepreneurial types of activities. And that doesn't just mean, a venture-backed company. That means opening up the corner, 7-Eleven or whatever, all those sorts of things. So those are things that I think economic development people don't look at as much. The other one that they hate to have me talk about, but I talk about it, is, public schools don't mean a whole lot to most of these folks because they send their kids to private schools. You need good private schools in most of these places. Most of these people are not going to send their kids to public schools. So, face reality in that regard. The entrepreneurs, the venture capitalists, those people want to send their kids to the best schools. And if you don't have good schools in that area, they're not going to come at the end of the day. Yes?
How do you think that crowdfunding is going to change the industry?
How do I think crowdfunding is going to change the industry? I don't. I think that crowdfunding has its place. I think that crowdfunding can be a very useful tool in creating very small businesses in a very local market. I don't see crowdfunding as fundamentally changing the venture industry like some people do. Now, people say, oh, that's because there's going to be thousands of investors in here and, venture capitalists aren't going to want to deal with that. And, same thing was said with the angel community. You can work out those issues eventually. I just think that, you're not going to crowdfund a biotechnology company. You might be able to crowdfund some, young startup IT company. But can you actually grow that company? And that's the important thing. I don't think you can. You can create companies all day long. But they don't meet the bottom line is most of them are going to fail. You want to concentrate on those few companies that you think are going to make it. And so crowdfunding, I think, is going to be a huge disappointment to a whole lot of people who are going to get burned. But like I said, for smaller companies in regions that do not have traditional forms of getting money, if you can't go to friends and family, if banks aren't giving you money, I think that this is a very good place, possibly, because the SEC does not like this, and they've made a point of it, because they still haven't put out the regs, the final regs on this. I think that you could see some interesting companies come out of this. From my perspective, the most important thing on crowdfunding is that it may create entrepreneurs at the end of the day that want to create another company, and they'll have by that time been seasoned enough through the crowdfunding process to really be good entrepreneurs going forward. So I don't like it being called a farm league or a training base, but if that's what it is, that's not a bad thing for the venture industry. In the back.
So seed funds seem to be emerging in a lot of cities and in the ecosystem where there's, let's say there's $200 million in the market. It seems like there's a tendency now to have $40 million seed funds instead of one $200 million VC fund. What does that mean, and is that good or bad, or how do you further that?
You know, this kind of goes back to the other issue. You can create a lot of companies, and they all can have 3, 4 employees, and most of them are going to fail. Or you can say, let's wait until we see the attrition rate here and put more money into fewer deals. I think that there's, from a venture perspective, you know, it's great to have other folks basically clearing the field. And, you know, if that's family, or if that's your own money, or frankly, if that's angels, from a purely selfish perspective, I'd rather see that. I'd much rather see a $200 million fund looking at Series A deals than 4 seed funds all looking at little companies that may not make it at the end of the day. Yes?
A couple of your slides seemed a little contradictory. One was talking about how exits are getting later and later, and then the other slide talking about more VCs doing early stage deals.
Right.
I think that would drive VCs to the later stage deals to get quicker exits. What are some of the funds doing to try to counteract that in their term structure or in their investment philosophy? What are folks doing to try to get quicker exits?
Well, what you're seeing is that now that you are seeing some exits, you know, the teenagers have finally left the basement. And you have that ability to look at earlier stage companies. And I think that's why you're seeing this uptick. You're starting to see this uptick in seed and early stage companies. Some of it, I also think part of it is also a recording issue. There are times when venture capitalists do not want to give out any information about their seed and early stage deals because they think they have the best, it's the next Facebook, and they don't want to tell anybody about it. There are other times when venture capitalists are more open because they want to see what's happening in the industry to actually disclose some of their seed and early stage deals. So I think some of it is that as well. There's no question that over the past several years, and now this is changing, over the past several years you did in fact see a movement toward the later stage because of LPs saying we want to see some returns. However, now what you're seeing, because you are starting to see some exits, and you're starting to see firms having to go out and raise new funds, those folks who are at that point of raising a new fund or have raised a new fund are going to basically start doing those early stage deals because that's where the returns are at the end of the day too. You're going to make a lot more money if you're successful in those early stage deals than you will on your later stage deals. So I know that some of that is contradictory and it goes firm by firm, but it's the reality of the market right now.
We've seen a lot of challenges in the life science industry for venture capital-wise. Maybe you can talk about what you're seeing, the general trends that are affecting the life science venture capital industry, and
Sure.
what your organization is doing from a policy standpoint.
Talking about the life science industry and what's happening there. You have seen a marked decline in first-time funding of both biotechnology and medical device companies. You have also seen, but you still see about a third of our dollars going into life science companies. So what you're seeing right now is venture capitalists coming in on the life science side at a later stage and sticking with companies for a longer period of time. You have seen a dramatic contraction in early stage biotech, while you've seen some increasing interest in later stage biotech, and you've seen more interest in medical devices today than you have in the last couple of years, probably. Then you have the whole area of healthcare services, which really I put into IT, which is actually, there's a lot going on in that area as well. But it's important from the pure life science perspective is that some VCs who consider themselves life science VCs are now doing healthcare IT. So that's a problem in that they're now don't have as much time to look at the biotech deals and the medical device deals. A lot of the reason why you have seen a decline in interest in this space has been, frankly, the FDA. And several years ago, we put together a group, and it's the only group that we have within MWCA that brings together both the VCs and the entrepreneurs. So we have a group called MEDIC that basically, when we go up and talk to the FDA, we don't just go in as venture capitalists, we always bring in portfolio companies with us. And we have been in a very good dialogue with the FDA for several years now. And regardless of your politics, one very positive thing that came out of Obama being reelected is that the FDA hierarchy has basically stayed the same. Because those folks really are starting to understand the importance of innovation as part of the equation when it comes to better health overall. That it isn't just about patient safety, that you also have to look at the other side of the equation. And like I said, regardless of your politics, I think that you're seeing a much more responsive FDA today than you have seen in several years. And I think that's only going to get better. So I'm actually more optimistic on the life science sector than I have been in a while as well. You're seeing venture firms who are out fundraising. You're either getting LPs who are saying, get out of that area, as I said earlier, or if you have been in life sciences and this is your fifth fund, you're seeing those funds being funded relatively quickly because LPs are saying, those guys have stuck to their knitting, they understand this space, I still want to be in this space a little, not a lot, and I don't want the generalists doing it. I want those people who really understand this area to be in it. So you're seeing those funds getting money. But I think it's going to be, you're going to have fewer deals at the end of the day because it's going to be a more expensive market. And then the next issue we have is not FDA, it's what price can we get for that drug or device at the end of the day. If we can't get the right price for it, it wasn't worth it at the outset. And so that's a whole nother fight that we're starting to fight at a whole different level of HHS. Yes?
Excuse me, I wanted to follow up on that. What do you suppose is the motivation in the increased interest in the life science area comparing medical devices to biotech? What's motivating that perception that's making them more interested in investment in medical devices?
Two things, cheaper and less time. It's that easy. They just look at it and say, I can get through a medical device company, I can get through the FDA pre-market approval process easier, it's going to cost me less money, and the one fly in the ointment with medical devices is that it's hard to go public as a medical device company, and there are few potential acquirers as a medical device company. So the exit market is harder, but it's cheaper and faster. I'm sorry, I've ignored this side of the room. Yes, in the back.
You have focused on the established venture capitalists as the main source. But what we're seeing now the beginning of roll your own cigarettes. You see pension funds, you see state endowment, even Midwest, incredibly, forming their own fund, investing money themselves. Have you begun to track that data?
Yeah, the story is basically, why do I need a venture capital fund when I can do this on my own? I'll take out the middleman. Yeah, I think there's always a flavor of the day. I think this is the flavor of the day. I think there are a lot of pension funds who think that they don't need the venture capitalists, or they don't need the private equity guy, that we can do this on our own. And I think that one or two bad deals and they will be back looking at the more traditional way. That might be a cynical answer, but I do think that that is that's really where we are. Did you want to follow up? Absolutely.
We've seen somewhat anemic venture returns over the last decade. So to witness Hunter Perkins have negative returns in their green tech investments, you're going to see more of this occurring with probably about the same goals as crowdfunding.
Yeah, I think that, there's no question that the returns in the industry as a whole, they are getting better, but they still are not great by any means. And LPs are becoming more and more cognizant of that. But the idea that you say, okay, well then I'll do it on my own, that's a whole different kettle of fish in my mind. Do we have time for one more question? I want to make sure that, I'm sorry, go ahead here.
Sure. When talking about the viability of IPOs, that was one of your final slides. Is Sarbanes-Oxley the smoking gun here because it never really recovered after the boom? It doesn't look like it's going to. Do you think that's a smoking gun? And if so, what's the remedy?
Well, I do think the Jobs Act helps dramatically on that because it gives emerging growth companies a 5-year on-ramp to become Sarbanes-Oxley compliant. So that's a long time for a company, to get its feet wet and to start complying. And I think that's why you are starting to see more companies. It's taken a year for that to get through the system, but I do think that is a help. I think a bigger issue from an IPO market perspective is analyst coverage. Most of our companies are not covered, and the reality is that you've seen a dramatic decline in individual investors in the marketplace. It's basically all huge institutional investors trading huge blocks of stock, and I think that until, and I don't know how you do this, until you're able to figure out a system that basically brings the individual investor back into the process, that you're going to continue to see the possibility of huge market fluctuations because they're trading on the nanosecond for reasons that we don't even know half the time. And the SEC, I think, has really gotten to the point where they're almost throwing up their hands that this has become so complex and is out of their hands that to me, it's from a long-term perspective, it's one of the more serious issues that we face, not just from a venture perspective, but from an economic perspective. One more question in the back there.
Follow up to that, it seems like the SEC is trying to destroy the intent of this Jobs Act, either through an action or onerous rule writing, and I was just wondering if you think that's going to play out.
Well, there are a couple of regards to the Jobs Act. They were not able, they did not have the jurisdiction to do anything on the on-ramp provision. So our provisions, the first day, and we were clear about that, crowdfunding, unquestionably, I think they have intentionally slowed down that process. And I think that once rules are finally put out, they are going to be so onerous as to make it relatively impossible for many entities to get into crowdfunding. And I think that is absolutely intentional. Obama made the point of saying how open he was to crowdfunding. I think it was a total smokescreen in that respect. I think that they did not want this from the outset, but they saw this as one of the few bills getting through, and they were going to ride that train. So that's the other reason to the earlier question that I don't see a lot coming out of crowdfunding at the end of the day. Some other parts, Reg A and some of the other pieces, they're putting out dribs and drabs. I think eventually, the law firms will work those things out. So those have not been major issues to us. Our provisions were much more the confidential filing and the on-ramp provisions, and we're happy with how that's worked out. Thank you very much. I think that.